Wealthy and Wise is your guide to value investing, powered by Teaminvest.
Well, a very warm welcome to this week's edition of Wealthy and Wise. All about inflation. It is back in focus in a big way, but its impact on investors isn't always straightforward because while rising costs can pressure some businesses, others can actually emerge from an inflationary environment stronger. So how should investors think about inflation, particularly through a value lens? Well, on today's Wealthy and Wise, we explore how inflation separates the winners from the losers and what to look for in your portfolio. We will also answer one of your questions. But to start, really to get a sense of what investors need to understand about inflation, let's get started and add some value. So when we hear about inflation, we often think of it through the lens of consumer inflation, and that matters for many companies. But for businesses, sometimes the real story is happening beneath the surface when it comes to rising input costs, labor, and energy. So let's discuss it all. Andrew Coleman from Teaminvest is here. Nice to see you, Andrew, as always. And also really pleased to welcome Li Bui to the program. She's an economist at AMP. I don't think we need to explain why inflation is really in focus, particularly right now. But we were already concerned about inflation prior to the Middle East conflict. So what is the state of play?
Yeah, you're totally right. We already have an issue here in Australia and not in a lot of other peer economies around the globe right now, which is a little bit of a hiccup for the RBA for this year, I think. Any statistics I say right now would be kind of outdated for investors, given all the risks. But let's just recap a little bit. Inflation was already way too high versus the RBA target, which is basically 2.5%. We have trimmed mean inflation at 3.3% and headline inflation at 3.6%. And we do expect that headline inflation numbers to have a 5 in front by the first half of this year. So not a very good look for the RBA at the moment. We do see wide inflation pressures from a wide ranges of sectors across the economy. So you do have the services sectors that includes health, education, travels, haircuts, gardening, anything really. So those have been seeing a lot of pressures. And in Australia, we also have these structural issues with housing inflation. So our construction costs are too high, our rental costs are too high. That feeds back into inflation as well. And this is before all of these issues from fuel prices, food prices, and a lot of manufacturing inputs from the Middle East as well.
Gosh, it is such a complicated picture, but we really do often tend to focus on CPI, what people pay at the Bowsers, what's happening in the grocery store. But from an investor's perspective, that's not really the full picture, is it?
Yeah, it is not. I think for investors, obviously there are winners and losers out of these stories. As with any cycles in history, really, obviously some businesses have more pricing power versus consumers. For example, consumer staples, for example, they still have to buy the same goods regardless of where we are in the cycle. So if they can pass on the cost through consumers, then, that's a good thing for them. It is a bit of a headache for economists, though, because when we see businesses pass on all their input costs, that means it feeds back to inflation. Consumers think that inflation is going up higher. They ask for higher wages rise. That means the input costs for labor costs for companies go even higher. So it creates this issue of a spiral, basically.
Yeah, it's like a negative feedback loop. So when you are doing the numbers, crunching the numbers, what is happening beneath the surface in terms of business costs right now? So labor, materials, energy.
So input cost is probably the first area that you see a spike in terms of prices. So over the last month, over the March month, I don't think this is the end of the peak in oil prices, but you already see the highest input cost surveys in terms of PMI surveys or business services across Australia and many other countries around the world, especially in East Asia. So we're seeing the highest uptick in input costs since late 2023, which I think is a little bit of an issue because remember back then we had inflation in Australia at 7.8%. Ideally, we don't go back there, but we are heading towards very close to that level right now. I think in terms of labor costs, it is quite manageable at the moment. Wages growth in Australia is just above 3%. But we are starting to see some headlines of higher Fair Work Commission's decision on minimum wages this year. So the Labor government is asking for 5% increase in minimum wages this year. So I'm quite afraid that would create that feedback, the second feedback loop in terms of labor costs for businesses as well.
There is so much to take into consideration as investors. So, Andrew, in your view, are we already seeing signs of pressure on margins or demands coming through in the numbers of portfolio companies?
Yeah, but I mean, as you've been saying, this isn't new, right? I mean, Australia's long-run inflation rate, except for the very successful period for about 20 years that the RBA targeted, has been just under 5% and about 4.7 for the last 100 years. So this is not new for Australia. What is interesting, of course, is that we have about an 18-month attention span, I think, as people. So from that point of view, if it didn't happen in the last 18 months, it's never happened before, in the same way as there's never been a problem with the Straits of Hormuz or the Suez Canal, even though there's one roughly every decade. So I think what matters is, as an investor, is how do you position yourself and how are the companies you're invested in responding to that? And that in the end always comes down to first principles. You know, a good business with strong pricing power that can insulate itself or get ahead of this will benefit. And those who don't have one of those three will suffer. And then, you know, it's just business as usual. Business as usual with a bigger price tag.
Yeah, all right. And so what it does is, you're saying that it doesn't impact all companies equally. It does separate some stronger companies from weaker companies.
Yeah, I mean, if you think back to episode 1 when we did this, we talked about valuing a business for most people using valuation methodology has some form of discount rate. And it regards some form of assumption around growth. So we have a top line figure growing and a bottom line figure being discounted. The inflation figures will effectively impact both sides of that equation. So some companies will find they can grow their revenue much faster than their costs. They will be net beneficiaries of this. You know, they can pass on the full price to the consumer while at the same time not absorbing 100% of that cost. And others will be in the other situation. They can't pass on to the consumer everything that they absorb. So you'll get both sides of that equation affection. The other one that I think you see playing out in the market is just the classic expectation argument, which is that because we have an RBA that targets an inflation band, and we know that we're outside of that inflation band, the logical expectation is that the RBA will increase interest rates going forward to try and rein in inflation, whether they're successful at that or not. And as a result, the time value of money increases. So in other words, money today is worth more than money tomorrow, both because inflation is eroding it and because the interest rate you can achieve on that money rises. And as a result, you see an overall dropping of valuations across the economy, which potentially is also partly because they were unrealistically based in ultra low interest rates that were unlikely to be sustained.
So what is, with that in mind, the RBA, in your view, trying to achieve at this point in the cycle? We have had the minutes released earlier this week. You've got to think that the RBA is in a very difficult position.
Yeah, I think what I got from the minutes was that they mentioned uncertain so many times. Obviously, they definitely don't have a clue to when this would end. I think the impacts from all of these conflicts out of the Middle East is kind of non-linear. So it means that if it ends very soon, the impact would be very short-lived. They probably shouldn't worry about it too much. But now I guess we're getting into the danger zone when it's been more than a month now. So regardless of whether it opens, the Strait of Hormuz opens tomorrow, we're definitely going to have a bit of a longer-term impacts here. We've only seen the first round impacts at the Bowser. We're definitely going to see the second round impacts on food prices and other manufacturing goods as well. So I think that's the tricky part for the RBA because, again, we already have a services inflation problem in Australia. Now it's heading goods prices, and goods prices, again, tend to lead services prices as well. So I think the issue for the RBA right now is that there's a little bit of a feedback loop here, and they're really trying to get ahead of the curve to basically contain that inflation expectation story from the consumers as well as from the businesses. I do get this question a lot of, what can the RBA really do? Because they can't control fuel prices. They can't control the fact that we have a shortage of housing in Australia. So I think, but interest rate is their only lever to contain inflation. So I think their hard choice right now is that they have to drive now growth. They have to basically bring GDP growth in Australia to a very slow level so that we have less discretionary spending. So we have maybe even deflation in certain discretionary pricing. For example, the fun things, say people don't travel anymore, people don't go to the movies anymore. That basically offsets the inflation part in the other half of the economy that they can't control.
It is so fascinating. So are we going to say something?
Yeah, I was just going to say, we're not talking about it yet, but, if this continues, we're back to 1991 and the recession we had to have, right? Yeah. The only way we're going to bring this in check, if it continues, is by dampening aggregate demand, which for those of us in the economy, as opposed to economists, I am one as well originally, but that just means pain. economic pain. We're going to have to shrink the size of the economy in order to get a handle back on wages.
Yeah, and not to
And
go
prices.
too deep into it, but those impacts from shrinking the economy from a recession are very long lasting, even in social terms. But we'll talk in the next segment about how it impacts businesses as well, because we will potentially see downgrades in some areas if we do see a recession or a quarter or maybe two of negative growth. So just to wrap it up, while we have you here, how should investors think about inflation from here? Because I think investors try often to get the macro right. Don't know if that's necessarily what they should be doing, but in your view, is inflation likely to stay elevated for a prolonged period of time?
I think we are going to see inflation heading down from here, from the second half of this year, not from here, sorry. Because I think that the RBA rate hikes would definitely have an impact in the economy with a bit of a lag in a few months. But I think for investors, though, it's really hard to time the markets, whether it's 1 month, 2 months, or 3 months. I think what people need to understand is that we are entering a world that's more inflation prone. We are entering a world where governments have higher debt, have more spending needs in terms of the aging demographics, have more spending needs in terms of defense. So all of that increase in government spending as well as demographics means that it's very easy for inflation to spike. We just need a little bit of a catalyst, for example, last month with the closure of the Strait of Hormuz. So basically, investors have to be prepared to invest in companies that have more pricing powers, that have basically better business model, because this is probably not going to be the last episode of spike in inflation that we're seeing.
Great.
Yeah, I think the challenge is if expectations become imbaked. In other words, we all start to believe we're going to have inflation for a long time, then it will become self-fulfilling because we'll put prices up in advance, people will ask for wage demands in advance, and it will continue to spiral. So the biggest thing the RBA has got to be aware of, and I'm sure they're very intelligent people, is around dampening that expectation, being seen to be doing something. Even if their levers aren't particularly good levers, they've got to be seen to be using them so that the expectations don't get ahead of ourselves.
Can I add one more thing? I think it's good for the government to kind of take a step here as well, because the RBA is not the only party that's responsible for containing inflation. I think there's a need for the government to boost productivity, because that's ultimately the best solution to containing inflation.
Certainly so. All right. Thank you, Boy AMP. Always a pleasure to have you. Andrew Coleman, Teaminvest, sticking around after the break when we go head to head. So understanding inflation and where it's likely headed is one thing, but investing through it is another, because as we've already established, not all companies are created equal when costs are rising. So in this next segment, we look at which businesses can pass on higher costs, which can't, and where investors can find opportunity in an inflationary environment. And joining the program is John Burkhold from TWC Invest. And also, of course, we've got Andrew Coleman from Teaminvest here. John, just to start, can you please introduce TWC Invest to our viewers and just tell us a little bit about your philosophy there?
Absolutely. So we're an evidence-based investor, primarily global equities, long only. And we have an approach where we are trying to understand the underlying profitability that a business is earning. And the key word when we talk about inflation is we focus on real returns on an after-inflation basis. Historically, accounting statements, actually, inflation flatters returns and profitability. So oftentimes in higher inflation environments, you see companies that look profitable, but in reality, it's nominal returns, not real returns.
Okay, interesting to throw that into the mix as well. And just reading through some of our background and listening to the previous segment, I mean, there's a couple of different ways to think about inflation. How do you distinguish between them?
So from my perspective, the traditional inflation is too much money chasing too few goods, and that's essentially monetary expansion, which is primarily the result of the RBA or the federal government spending, creating money out of thin air to invest in projects. Then there's what we're encountering now, which is effectively a supply side shock, which will drive inflation up because literally the price of a particular commodity has gone up because it's the amount available has dropped. So they're very different environments. We've, as I think Andrew indicated, we've lived through high inflation for a while now in Australia. So thinking about what's worked in the last 18 months would be helpful in thinking about the next 18 months if it's purely sort of a monetary inflation sort of environment. if we are going into a prolonged period of supply-driven inflation, that's a very different kettle of fish, and honestly, equally dangerous, but a lot of cross currents on offer.
Yeah. So, Andrew, does it matter to you as a value investor whether it's too much money or a supply shock driving the inflation?
I mean, it matters because it's fun to talk about. So I agree. And they are very different. But I think if you look at it from a fundamental point of view, down at the individual business level, then it really doesn't matter what's driving it. What matters is how you respond. So from that point of view, I think it's sometimes worthwhile separating, you called it our macro hat before, but our macro hat, which is what's going on, and the micro, how are we responding? And from an investor's point of view, I always joke the macro is what gives you the fun stuff at the barbecue, but the micro is where you make your money. So macro is what we'll want to talk about, but there's no money in macro. The money's in the micro. How does this specific business respond? And I'll give you just a really simple example. You could have two companies exposed to exactly the same shock, one of which puts its head in the sand or runs around like an idiot and makes bad decisions. That's likely to end up as a bad investment. And the other one will benefit, even if it does nothing, just simply because its competitor is messing up. In the words of Napoleon, never interrupt your enemy when they're making a mistake. And I think that that's the discussion that is so often lost from an investing point of view. We as citizens will be hurt by this. Businesses have to respond by this. But the money is made in how we respond, not what the response overall is.
Wherever you are in Australia or New Zealand, there are investors like you who are done going it alone. The best investors we know aren't just disciplined, they're connected. Teaminvest is an exclusive membership for long-term, self-directed investors who approach investing like business owners and compound their knowledge alongside 700 plus peers. Masterclasses held across 9 cities. Register your interest by clicking on the link in the caption.
When you are thinking in a too much money environment, which arguably we still could be falling into that trap when it comes to inflation, even by some of the government's move when it comes to this supply shock that is also driving the inflation, what in your view tends to work, if I can put it that way?
Well, historically, if we think about inflation leading to higher interest rates, then you want to own things that are not impacted by higher interest rates, in simple terms. So historically, that is typically grocery store companies that can pass on prices, take their margin and move on, or companies in the technology or the healthcare industry where, again, they have relatively high margins, and so they can effectively not be as impacted as the as firms that that operate at a much lower margin. But the other side of it, of course, is the firms that might benefit from higher levels of too much money chasing too few goods, which has historically obviously been the commodity businesses. What's kind of interesting right now is obviously a lot of the commodity businesses are being hit on the cost side by the higher cost of petroleum and the like.
Yeah. So do you agree, disagree? I think we might live up to head on this one because you're not a big fan of commodities at the best of times.
Yeah, I think that's the only one we disagree on. I think you're right. Software companies, ticket clipping businesses in general, so anyone whose revenue is tied to the nominal value of the goods. So I'm thinking they're companies like Jumbo Interactive and REA Group and car sales who get a percentage of the ticket size. If there's inflation, even though the good hasn't increased in value, the price with which it transacts does. So the margin you charge for your piece of software just went through the roof without you doing anything. It didn't cost you any more to operate the software, but you got a percentage of a bigger number. So they tend to be net winners. You mentioned businesses with low cost advantages or healthcare and insurers where people are price insensitive. And I think the other one simply is companies whose competitors are loaded up with debt or poorly run, which was my comment before. It's not necessarily that they don't feel the impacts. It's that if their competitor loses market share faster than them, even if that section of the industry is shrinking, you can still be a winner because you gain market share at the expense of a poorly run competitor. I mentioned the only one we probably disagree on is commodities, and that's not so much the fact that commodities don't increase in price. They do in the cycle. It's that historically we, I think, have tended to do what I joke is the same problem, which is we think of, electrons moving in concentric circles because that's how we were taught at school, even though 50 years has said it's wrong. And we still think of as Pluto as a planet. I'm quite passionate about that one, but obviously it's no longer because we still to some extent think of money and monetary systems as being driven by precious metals, gold and silver. And for most of human history, they were. The coins were made of gold and silver. But, since the end of Bretton Woods in 1976, that isn't the case. But we seem as investors to have kept in our mind this idea that when inflation rises, go and buy gold because, it preserves its real purchasing power. And of course, the data shows since 76 it doesn't. Gold does not rise in line with inflation anywhere near the way we think it does, because we're still living in that old paradigm where they were linked one-to-one.
Right, to reply, John, because we did see gold prices rise exponentially last year, and it was an inflationary environment.
Absolutely. When we talk about management quality, which of course is a big focus at TWC, we're looking for well-managed businesses, those that earn higher returns and deploy capital more intelligently than their competitors. Gold is the ultimate arbitrator of RBA competence and to some degree government competence. So we've seen an explosion in gold prices over the last 3 or 4 years, and given the massive fiscal deficits that a lot of countries are running, and the fairly benign sort of solve the problem by lowering rates, I actually think gold on a longer term basis will do exactly the opposite of what Andrew is saying. I think it will outperform monetary assets. No better way to look at it than Australia going from the wealthiest country in the world 100 years ago to less so, but now because there is natural resources, again, bouncing back. Within Australia, obviously, the Aussie dollar moves dramatically and is also an arbitrator of the market's view as to whether or not this country is well run. Right now, we've got on the 30-year and the 10-year bonds about a 70 basis point premium over the U.S., despite having a credit rating at or better than the U.S. So I think, markets speak as always. And as always, it's fun. What I love about this industry is we'll know in 5 years who's right.
Yeah, absolutely. So, but back to one of the points that we've touched upon earlier, is pricing power a key thing that you look for now, more now than prior, or always?
Always. A business that can charge what they want is always more attractive. But that's generally where the more asset-light businesses that are way more productive than your sort of heavier halo-type industries has historically worked. And that's what we've seen if you look at the U.S. versus the rest of the world over the last 15 years. The average U.S. company earns a much higher real return on investment than the more asset capital-heavy businesses. So the question will be what businesses can do that. What's interesting right now, obviously, is there's this whole SaaS apocalypse. A lot of those businesses actually could very easily turn back the dial on CapEx and generate a lot of free cash flow if they chose to. So as a global investor, I would recommend people take a look at the Googles of the world and the Microsofts and the like, simply because they've committed to a lot of spending, but they can uncommit very quickly. They can taco just as easily as Trump.
Wow. Okay. There's a line we'll remember. So, Andrew, how can investors tell if a company genuinely has pricing power?
I mean, just look at the past history, right? If it's got high margins, high return on equity, growing profits, it must have pricing power, because you can't sustain that for the long time in the face of competition if you don't have any. But I think sometimes we make this mistake. We've talked about this before, of trying to answer the difficult question rather than the easy question. So the really difficult question is always who's going to be the winner. Sometimes it's easier to flip it and say, who's going to be the loser? And if I just avoid those, then overall I should do okay. And I think that's simpler in a time of higher inflation, because really there are 5 key areas where there are likely to be big losers in the economy. The first is any business that does fixed price work gets hurt when there is higher than expected inflation.
So the mining services.
Mining services companies, building and construction companies, REITs, etc. And that's not because they're badly run. It's just simply if you've committed to doing a job for X price in 2 years' time, and the rising price of what it costs you to do the job rises faster than you expected, you have to wear that. Therefore, your margins will contract, and those of you on really thin margins may even go bankrupt. So from that point of view, fixed priced work works really well in a steady environment, low inflation environment, hurts you very badly in a rising environment. And you saw this in 2019, 2020, 2021. So again, look back to the companies that suffered there, companies like Stockland, Charter Hall, Goodman Group, Dexus, GPT, Min Resources, Worley, etc. Even though some of those are exposed to growing commodities underneath them and needs, data centers, mining, etc., they themselves may lose on the contracts that are currently on their books, and depends on how much they lose as to how much you end up losing as an investor. Small bit of pain they can live with, big bit of pain could be catastrophic. The second is businesses with low moats or significant competition, which effectively means they cannot pass on the price rise to their customer. So, an example, there's someone like Harvey Norman that plays in a highly competitive landscape. Not only do they have JB Hi-Fi and Good Guys and all of those in physical stores, but they have all the online stores that can compete with them, such that if the price of their inputs rise, how much will the consumer allow them to pass on, meaning they have to absorb some of it? And I've thrown in, from a software point of view, Xero there as an example of a potential loser. Not because Xero doesn't have the ability to pass on, but they're getting new competitors through AI at just the wrong time, which means if I was in their shoes as management, I'd be very reluctant at putting a price rise in right now in case I spook the horses. So as a result, they're going to absorb the cost. The third group is regulated industries who may want to and be able to pass on the cost, but the government says you're not allowed to. So, AGL, Origin, IAG, Suncorp, QBE, these are all businesses that should be able to pass on the cost. They have effectively monopolies in their space, but they're regulated. The government can turn around and say, you will not have the price rise that you want.
Well, we haven't seen that happening with the insurers, right? And I think you are on the opposite end of the spectrum there.
Well, I disagree with very little what Andrew just said. I think the insurance companies historically have been attractive because they have a float, and higher interest rates mean they can deliver more profit from the float, the money they're holding in order to pay out the claims. However, Andrew's exactly right. If there is a situation where you are government regulated, then all bets are off, and I would avoid those like the plague in that environment.
And it's worth thinking about them as different. So, and I agree with your point entirely. Someone like NIB or Medibank, their price is capped by the government. They don't really have the ability to charge more if medical inflation goes up beyond what is considered acceptable by the politicians to raise. Whereas on the other hand, a true general insurer like doing motor cars, well, that's what the market can bear. So you do have to look at them a bit differently. The fourth category and fifth category are pretty similar, but they are the companies who suffer from general market downturns. So in other words, where their customers get hurt in a general market downturn, no matter what causes that, well, that's going to flow through to their bottom line anyway. So, things like the big banks, travel companies, car retailers like AP Eagers. And then lastly, and the group that always gets hit the most whenever there's a problem, but weirdly we seem to talk about least because I think it's boring, but it's important, is just unprofitable companies who have a CapEx commitment coming up or have a lot of debt, because as inflation rises, the cost of that CapEx and the cost of that debt goes up exponentially. You mentioned it before. If cash is coming in the door, that's not a problem. If cash isn't coming in the door, that's existential. So I think if you look at it that way, it's sometimes easier to pick who the winners, almost by process of elimination. Ask, is the company doing fixed price work? If no, great. Does it have low margins? If no, great. Is it a regulated industry? If no, great. Does it suffer in general from a market downturn in its history? If no, great. And is it unprofitable or laden with debt? And if it's not one of those five, you're probably going to win.
Boy, you're getting the funnel really tight there at the end, but I know that you don't think you need to hold a whole heap of stocks regardless. But it is a little different at this time than it was even, say, 6 months ago because of this Strait of Hormuz closure. So do you, John, look at infrastructure, the APAs of the world, the Viva Energies of the world, a little bit more favorably now?
Again, generally, we tend to avoid those businesses unless we are seeking out yield. And to extent there are low return businesses that are cash generative and pay out a fair amount of the income that they create, even though they're low return, then that's attractive because obviously it's a proxy for bonds. Given that most investors in this country struggle to buy bonds directly, given the minimums are very high for the most part. So there are businesses like that are attractive. Horizon's another one that you could put in that category. But again, back to the very, very important point, if there is debt, then they need to be able to service that debt and arguably pay it down aggressively. In this type of environment, paying down debt might be the most wealth creative activity they can do. And so I would look for managements that understand that don't put their head in the sand and are actively trying to make the business more productive and lower the risk in terms of financial leverage.
Yeah, we're not going to go. Sorry, go ahead.
I was just going to say one company that I think is interesting in that space that is currently being impacted pretty aggressively by higher petrochemicals is Amcor. They've brought in a fair amount of debt. They've made a significant merger in the last 18 months, but they are committed to making the business more efficient and to reducing that amount of leverage. So you can just buyer beware. You're going into a higher risk environment. And I guess the final point would be look for innovation. We talk about this a lot in terms of just finding businesses that are doing something different, that are disrupting the status quo, bringing something new to the table. They often do not have the same pricing power or pricing pressure that you would encounter with more mature sort of what I'd call price takers.
Mm-hmm. So, it's a fascinating discussion, but for investors, Andrew, how important or unimportant is it to get the macro call right? Or should I phrase it differently? Focus on company fundamentals, correct?
Yeah, at the end of the day, you don't own the economy, you own individual companies. So we're all exposed to the economy. It's interesting to talk about and it matters for our day-to-day decisions. But as a long-term investor, if you're intending to own an asset for 5, 10, 15, 20 years, you're going to live through multiple economic cycles. An average economic cycle is 5 to 10 years, right? So by definition, this is going to happen. It's going to go up, it's going to go down, it's going to go up, it's going to go down. And it does regularly. We're all old enough here to remember these cycles. They're normal. So from that point of view, if you own an asset, not the economy, and you're intending to own it through a cycle, this is just mostly noise. It's interesting noise, and I enjoy talking about it, but it's noise.
Sadly, I 100% agree. I've in my over 4 decades in this industry, I've never encountered a fund manager who talks macro, acts macro, and delivers consistent returns. It's virtually impossible. So really, don't bother. Try to think about the micro, the business, the management team. What is the product? What is the company doing? Who are its competitors? Is there a moat? And then most importantly, which is very difficult for the average investor, how much of the good or bad news is in the share price? And that's ultimately what our process brings to the table is we can ascertain it's a good business, but is it priced to be a great business, an average business, or generally most companies are priced to be exactly where they are.
John Burkhold, TWC Invest, great to have you join the conversation. Thank you so much. Andrew Coleman from Teaminvest will be sticking around to answer this week's viewer question. And if you would like to ask a question, you can email wealthy@ausbiz.com.au. Today's question comes from Jennifer in Sydney, who writes, what's your view on Macquarie? Do you, and I'm assuming she means Teaminvest, totally avoid big banks? If so, why? Andrew?
So I'll answer the second part first, which is yes, we tend to avoid big banks in general. And the reason for that is 2 things that are relatively unique to Australian banks and 1 thing that is pretty globally the case with banks. So I'll take that one first. The first is that banks as a whole tend to be far more volatile and risky than we think. Every time there's a major downturn in any economy around the world, one of the biggest losers is always the banking sector because of the nature of their business. They're taking short-term paper, deposits, etc., and turning that into a long-term dated risk, mortgages, business lending. And so you don't have to get a lot wrong in your model for that to become very painful. And it becomes even more painful because they use leverage historically to juice up the difference between those two. And so through pretty much every major global downturn in every country, there have been big banks that collapsed, at least for equity holders. So what I mean by that is even if the banks didn't cease to exist, equity holders' capital was either completely wiped out or so diluted that it was effectively gone to zero. And you see that not only in big examples like 1929 and 1960 and 1970, but even recently, Credit Suisse, one of the largest banks in the world, where I used to work many years ago, ceased to exist in a period of 3 months of turmoil in Switzerland only a couple of years ago. We in Australia almost lost ANZ and I think it was Westpac in the middle of the GFC if it wasn't for the government guarantee that stepped in. Which brings me to the 2 reasons why Australian banks are particularly at risk, but we don't see it. The second of the 2, other than the general business of banking, is that almost all our funding for Australian banks comes from offshore markets. We are almost exclusively funded out of the global money markets, particularly in New York and Europe. And the second those money markets close, and they do close, our banks get stuck with a huge liquidity problem. And that almost took down 2 of them in 2008 of the big 4. It did take down some major banks in 93, and it took down even more in the 80s. For those viewers who will be around, you'll remember names like some of the state government banks that ceased to exist. And then the third thing, which is a particularly Australian problem, is that almost all of our major banks these days are exclusively invested in residential mortgages. They're mortgage houses. They're no longer banks. They don't actually do business lending, and they don't do transaction services. The vast majority of their lending is to consumers on homes. And that's been fine for the last 15 years when house prices have gone steadily vertical. But over that time, because they've gone vertical, the risk on their book has increased more and more and more, because we have created policy after policy decision to allow us to lend to poorer and poorer risk customers to help them get into the market. Used to need a 20% deposit, and it became 10. Now it's 5. And we're changing all sorts of rules around that, which means that our banks are particularly exposed should the unthinkable in Australian terms happen, and that's Australian property prices decline, or we have larger unemployment. Now, at the moment, we don't have either of those two, so they look nice and safe. But if you're a long-term investor like us, and you're saying, I want to be virtually certain that my asset is not only going to be protected, but worth materially more in 5, 10, 15, or 20 years' time, those are risks that are just too big to help you sleep easy at night. Now, the question was about Macquarie, which is an interesting one, because Macquarie, of course, has historically not been a mortgage bank, although it is now becoming more and more so as it grows. As a result, if you wanted to own one of the 4, historically, Macquarie was usually one of the better options. But then it has the other exposure, which is to the investment banking side of the business, which perhaps offsets... commodities, which perhaps offsets any of the gain of not being only in one sector. As a rule, though, my comment would be stay away from them. They tend not to do particularly well through the cycle. They go up and down. You know, we had a big up period, now we've got a down period. Their earnings growth tends to be slightly faster than inflation and not by a lot. And you always sit there with a materially larger risk than you expect, which is that all of that huge, multi-times leveraged amount of money that's out there in the economy tends to all come due at exactly the same time for all of them.
So Macquarie, not attractive.
No, I mean, I think it's a very well-run business. I think all of the large Australian banks are very well-run. I think they're amongst the best in the world. But it's a sector that carries far greater risk for an equity investor than I think most of us ever realise, until we have a crisis and suddenly watch the value of that investment explode, or perhaps implode.
Andrew Coleman, Teaminvest, thank you so much. Thank you for your viewer questions. Thank you for watching. We hope you enjoyed this edition of Wealthy and Wise. We'll see you next week.
We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.